Hello and welcome to our first SwitzerTV property program for 2020. And on tonight's program, we'll be checking in with the Chief Economist of Domain to see whether we can really believe in this house price recovery, particularly in Sydney and Melbourne. And we're also seeing some good signs in Brisbane as well. And then we'll talk to Tom Panasas, who's been a long-time property expert and a consultant to News Corp and of course REA on what he's seeing in the markets in Sydney and Melbourne, Brisbane and Canberra, and whether we also can believe in what we're seeing in terms of this recovery, an unbelievable recovery in house prices. He'll also give us some analysis on how you can pick a hotspot when it comes to real estate. And then finally, Tim Slattery from APM Property Group will look at how you can invest for income in property, and particularly in areas like commercial and non-residential. That's the program for tonight. If you like this program, make sure you press the like button and sign up to become a subscriber. It goes out, as we say, on our Switzer Financial Group YouTube channel, and you can get that each week. We go out on Thursday nights. So without any further ado, let's go and talk to Trent Wiltshire, the Chief Economist at Domain. Thanks for joining us.
Thank you.
So, Trent, looking at some of the numbers from probably other data suppliers, I think Sydney and Darwin were the only cities that actually experienced a fall in price last quarter. I kind of understand Darwin. Darwin has been struggling for a long time, along with Perth. Yeah. But everyone's saying, oh, Sydney prices are going up. So how do you reconcile that?
No, our data is definitely showing Sydney prices are rising and rising rapidly. So I've got the preliminary numbers from our December quarter, and that's showing a almost 6% rise in the quarter for Sydney houses, a bit less for units. So since March, the median Sydney house price up by about 11%. So a big rebound in late 2019.
And you're an economist. These could have been September quarter numbers. And really, house prices didn't really start taking off again until we got past the election and the interest rate cuts started to kick in.
That's right. So our numbers sort of show it's bottoming out in the March-June quarters. And then we've really seen them take off, particularly in the last quarter, in December quarter.
Being an economist who is specialising in the housing sector, are you really surprised how quickly the market has rebounded after how severe the price drop looked?
Absolutely.
Yeah.
Like the rebound is remarkable. I don't think anyone called the extent of that rebound. People were thinking that with rate cuts, with the election out of the way, yes, there could be a bit of a bounce, but not the sort of
moderate comeback.
Not the 5% quarterly growth, potentially double-digit sort of annual growth we might see in 2020. Which I'm saying it's not a good outcome really. With obviously lower rates works through housing, but ideally a modest rebound would have been good, not the extreme rebound we're seeing.
But I guess when interest rates are so low that most borrowers now can get loans in the 3s or 4%. It means it's so rational that they go looking for houses, but the prices are going to cut a lot of people out.
Yeah, for sure. And I think it's not just the rate cuts, it's the expectation that rates will stay low as well. And the RBA really made that clear last year that we're cutting rates and they're not going up for a while. And I think we'll see that for the next few years, that there'll be mortgage rates in the 3s, in the 2s, people sort of locking that in. And people are paying down debt quickly as well, so we see that in the credit growth data. It's not really growing quickly because people are paying off their loans and you take advantage of these lower rates as well.
And I don't know whether you're qualified to comment on this, but I'm sure you've come across the same stories that I've read, that even when we look at our household debt to GDP numbers, there's no deductions for the fact that a lot of people are paying off their debt at a really fast rate, and they've got these big offset accounts which effectively reduce their real debt to their own personal GDP.
Yeah, I wrote something on that last year, like looking at the headline number is very concerning, 190% or so.
The worst in the world, Steve King would tell you.
But offset accounts make that rise less extreme. Also, a lot of the run-up in debt is held by higher income, higher wealth households as well. So definitely the headline number is more concerning than what the the other sort of more detailed numbers show.
And I guess another contributing factor is that unemployment's not rising, it's kind of levelling off and could even sneak down if we get economic growth, particularly after the bushfires and all the spending that's going to come from government.
Yeah, I think will really depend on, we'll see how well rate cuts work in terms of delivering lower unemployment and higher inflation. That's what the RBA, they've been holding their hands because they didn't want to cut rates to start another house price boom. They've been forced to cut rates because they realise, we need unemployment at 4.5%, 4% potentially to get inflation up, to get wages growth going. So unfortunately, it really is just working through the housing market. It's working through house prices. That will have that wealth effect. It'll flow through to the rest of the economy, but the consequence, the unfortunate consequence, seems to be a really fast run up in prices, particularly in Sydney and Melbourne, but other capital cities are looking to follow as well.
First home buyers made a fantastic recovery or comeback to the market when house prices were falling. What's happening to first home buyers now?
Yes, they've picked up at sort of the same proportion as overall owner-occupiers. So you look at the lending data, overall owner-occupiers up by, I think, about 20% since May. But first home buyers sort of similar proportion. So it's not just first home buyers, but it's more of an owner-occupier story rather than an investor-led recovery.
Should make the left-wing critics of me on Twitter more happy than they usually are.
And, well, you see that in the consumer surveys as well. People thinking now is a good time to buy. That shot up a lot as people's price expectations rose as well. People wanted to get in before prices started to rise too far.
What's the effect been of the negativity around apartments because of cladding and the fact that some buildings are falling apart? Has it made them cheaper, and has some first-home buyers started looking at these apartments?
You don't really see it in the aggregate numbers, from what I can tell. Like on our Melbourne units data, the units are at a record high, the median price. They've kept rising, really just a modest correction.
So first-home buyers couldn't afford them?
Potentially. But in Sydney, more of a dip, but they've sort of rebounded as well. So, in that aggregate numbers, in the median number we report on mostly, don't really see it. I think it will shift some apartment buyers to the better known developers perhaps. People are probably more wary and do more research before buying. But not a huge impact overall.
Do you believe the predictions out there for Sydney and Melbourne, like 12 or 13% price rises this year?
I would have said no a couple of months ago, but given everything that's been going on, home loan commitments shooting up, interest rates falling, sentiments up, clearance rates have remained around 70%, even with volumes picking up. I can see double digits potentially for Sydney, Melbourne.
As an economist, is the best way of reducing this galloping price rises increasing the supply of properties and reducing the number of migrants coming to the country?
Definitely on the supply side, I've been an advocate for a while. Like we can see that working in the Sydney rental market. We've seen Sydney rents falling for the past year or two. That's really because of this massive apartment construction boom that's gone on. That's worked through rents. Doesn't quite translate into prices so immediately because they're obviously driven by interest rates as well, not just sort of supply and demand for people to live, somewhere to live. In terms of migration, population growth, yes, it's been very strong particularly into the capital cities. So Melbourne sort of 2.5% a year. That has puts upward pressure on prices, no doubt. But it's about that supply side. If we make the supply side more responsive, when demand increases, we can build more housing. So I just saw today the Brisbane City Council banned townhouses in the established suburbs. Those sorts of policies mean house prices will be higher than they should be, and that hurts first-home buyers.
Have you ever done any work on how council obstructionism, if such a word exists, not a bad word, I might use it more often, is actually reducing the supply of properties that developers would like to put on the market, and that's part of the problem, isn't it?
So I worked on a report at the Grattan Institute, where I used to work, and we had a couple of examples of where councils really use different tactics to try and delay development because councils respond to their local voters and we know there's a lot of NIMBYism. People don't want development in their suburb or in their street. They're happy for it, the neighbouring suburb or the neighbouring council.
Their kids can live there but not in there.
Yeah, exactly. And councils respond to that sort of rationally and say, okay, we won't allow development if we can avoid it. So I'm an advocate for state governments need to set targets and councils get rewarded for meeting targets, the carrots and sticks approach. The federal government can also play a role in encouraging zoning reform, planning reform, making cities become, increase their supply responsiveness, and I think that will help housing markets across the country.
Do you think sort of like an outside the square solution to a lot of our housing problems would be to improve transport, for example, very fast trains that take people from country areas into the city pretty quickly, and therefore people can move to the country?
I think that would work if where we built the train sort of where they began, where if that was very responsive and you could build lots of houses quickly. But actually in regional towns, it's not necessarily that much easier to say subdivide and build housing anyway. So it might ease a bit of price pressure in some parts, but it sort of will spread out a little bit. That's not to say it's not a good reason to do it, to potentially build better infrastructure, connect those sort of big satellite cities like Geelong and Wollongong and Newcastle, which is happening, but probably people would prefer that.
Well, Trent, I'm kind of out of questions, but my final question to you is, what is it that you've come across recently that you think people who are interested in the property market, what are some of the big revelations that have come across your desk in the last few weeks?
Yeah, I think I saw the sort of debate going on about whether prices are actually rising late last year, and with REA and with CoreLogic and with our data and what's going on. And our numbers clearly show it's a big rebound. It's Sydney and Melbourne focused, but it is spreading to other capital cities. So Perth has seen small quarterly rises.
At long last?
Yep, 2 consecutive quarters, first time since 2013. Canberra's looking pretty strong. The Hobart boom looks like it's taken off again. So it's clear that it's happening. In terms of within Sydney and Melbourne, it seems like the biggest price rises are occurring at sort of the middle to more expensive end of the market, so the $1 to $1.5 million range. So it's not the premium end, but it's also not the bottom of the market, but that's not unusual in a recovery. We typically see that sort of part of the market, particularly in Melbourne. The top end of the market leads the overall market, so I wouldn't be surprised to see faster price growth at the bottom end of the market next year.
So is there anything out there that you think could turn this price rise rebound on its ear?
Yeah, I think the big one is whether APRA, the banking regulator, gets involved and sort of tries to slow down lending. And they did that in the past, in the previous boom, but that was more, it wasn't aimed necessarily at slowing price growth, it was aimed at reducing or slowing speculative lending. We're not really seeing that in this rebound, so they would have to use different tools and different reasons if that was the case. I think if the Reserve Bank changed its tune quite a lot and said we're not lowering rates any further, that might have a bit of an impact as well. But I think another rate cut is almost certain this year, and that will probably add further fuel to the fire.
Well, on that subject, the bushfires in many ways might encourage the Reserve Bank to cut again just to keep the economy kicking.
Potentially, they tend to sort of look through the temporary things, but they were unprecedented bushfires, so it is really hard to know how much of an impact it will have. It's
dangerous to treat these bushfires as being a temporary thing, as the Prime Minister's found out.
Yes.
One last question, because you brought up APRA. Part of APRA's decision was to try and curtail the buying of Australian properties by Chinese and Asian buyers. I don't think APRA ever admitted to that, but a hell of a lot of lending organisations that were lending to Chinese stopped doing so. Are the Asian buyers coming back again, particularly after the Hong Kong problems?
You can track where people or look at properties from. We are seeing a bit of a pick up in terms of inquiries from overseas. Whether that continues, whether the rules
post-bushfires changed.
And I think the dollar will have a big impact as well. So if the rates get cut and the dollar sort of slides a bit further, and that makes property look relatively more attractive. So that could be another factor. And I don't think we'll see the same boom as we saw a few years ago, but I think it might pick up from the low point we saw recently.
Trent Wiltshire, thanks for joining us.
Thank you.
That's Trent Wiltshire, Chief Economist at Domain. Well, my guest now is Tom Panos, who's a 30-odd year veteran of the real estate industry and is seen as an expert and as a real estate consultant to News Corp as well. And of course, REA and all those sorts of businesses. Tom, great to see you.
Thank you. Thanks for having me.
I wanted to talk to you because there are a lot of things going on in real estate, and a lot of normal people who watch this program have lots of questions, and they would love to sort of corner you at a dinner party and pester you around the subject they care most about, namely property. So the housing market recovery, A, has it surprised you how quickly it's come back? And B, tell us what you think is happening in cities like Sydney and Melbourne.
Question one, Peter, has surprised me at the speed of the recovery. Like, it seemed to have happened over a 10-week period. It was really clear. It pretty much happened while I was overseas in Europe. I mean, I left around the 1st of June last year, and I came back at the end of July, and all I can tell you, running my own auction business, where I auction 10 or 12 properties every Saturday, I would drive up to an auction prior to the federal election, and there would be one or sometimes no people registered. I get back from Europe. The first week, I pull up to a street in Newtown. I think it was Wilson Street, Newtown, and the street was full of cars, and the real estate agent said to me, Tom, this all happened over June, July. Buyers started coming through, and what has really surprised me is in most instances, particularly Sydney and Melbourne, the losses of 17 and 18 have been picked up between August and December 2019. So that's 4 or 5 months seem to have picked up the losses over a 2-year period.
Staggering. The property demand in Sydney, is it going to be sustained, do you think?
Look, I don't know 100%. All I can do is go based on data and anecdotal evidence from real estate agents.
And gut feeling from the history of being at the coalface for a long time.
Correct. So here's what I can say to you. The amount of people going to open for inspections from January to today has been the highest it's been in years. That's a positive sign. It means there's people looking. The second thing is there was a heap of stock, particularly in the eastern suburbs of Sydney, and I was in Double Bay yesterday talking to most of the real estate agents. There was a heap of stock that hadn't sold over the last 8 weeks, and what happened is since Christmas, this stock has been swallowed up and good money been paid for it. So there appears to be this appetite. Now, we're not going to get a clear view on how robust and strong and sustainable it is, because in Sydney and Melbourne, the auction capitals of real estate in Australia, what happens is after Australia Day is where the real action begins. In fact, the first big open for inspections happen pretty much Australia Day weekend. And then the auctions that occur on the 22nd of February is a large sample size that's going to say to you, hey, this is 90% clearance rates. So the sample size at the moment is not high because very few people are going to auction at the moment.
Yep. So there was reports over most of last year, and a lot of the real estate agents were saying, we haven't got any stock.
Yeah.
Has the stock supply improved?
Yes. It appears that coming back from Christmas, two things. So I don't just measure in my business the stock. I measure what is known as a market appraisal. A market appraisal, Peter, is, and you'd know it, but I'd explain it for the viewers, is the meeting a vendor has with an agent as they're putting their property on the market. So these things can actually be traced back to companies like CoreLogic and what have you. You can actually track how many appraisals have been taken place. There is a large number of appraisals, which means there's a lot of people that are calling agents in to say, what's my home worth? Most of these end up transpiring to become a listing on the market. And I can tell you, I was talking to a guy in Double Bay yesterday, Paul Biller, he's told me he's got, 12 things already signed up and ready up for auction, and that is like 2 or 3 times what he's had in previous years. It appears that stock levels are starting to increase.
Okay. What about a city like Canberra and rentals? Because historically it's always been good for rentals. What's it like now?
Okay, so in Canberra, again, another market that has probably fared better than Sydney, Melbourne during the downturn. But if you speak to most real estate agents, they will say to you, We wish we had more homes to let. We wish we had more listings to sell. There is demand in that marketplace, no question about it. It represents good value for money for what you get.
And I guess property investors have done pretty well out of Canberra over time, haven't they?
Yeah, property investors. Canberra's an interesting one because you actually get a reasonable yield and you get reasonable capital growth. In most markets across Australia, you don't get both. Like hypothetically Newtown, you'll get a terrible yield. It'll probably net you around 2% in residential net, but you'll end up getting growths of around 10% a year. Then you go to other parts of Australia, you know, I don't know, Cairns or Townsville, you'll get yields of 8-9%, but things just don't go up, you know. So Canberra's an interesting one because it's on the higher end on both things. So if you've been a Canberra owner, you've done okay.
Okay. A lot of people living in Sydney and Melbourne often buy rental properties on the Gold Coast, Brisbane and Sunshine Coast. What's happening there?
Okay, so Brisbane's an interesting suburb. Well, firstly, let me just say those markets are far better for houses than units, right? Because there are certain pockets, you know, Gold Coast example, where there is just multiple apartments there, and the demand and supply curve simply says that, you know, if a buyer doesn't buy that unit, they can go buy another one, so it never puts a lot of pressure on prices to go up. Brisbane has been, you know, like Brisbane is the one place in Australia where you can guarantee there are more people moving into than leaving, right? You know, the focus is there. That's what's happening, you know. The number of people going in far exceeds the number of people going out, and that's been a positive side. Sunshine Coast, again, is a bit of a discretionary area because Sunshine Coast money, example Noosa, is highly linked to Sydney, Melbourne. If people in Sydney and Melbourne are doing good in their own real estate, if people in Sydney and Melbourne are picking up good bonuses for the works in financial services or whatever industry, they seem to put money into that marketplace, and it appears that Sunshine Coast is going to benefit out of the increase in Sydney and Melbourne prices.
Okay. You are a Sydney boy, I know,
Yeah.
but you take a national perspective. One of the big challenges for property last year was cladding and apartment blocks that were cracking up. What's that had on the consumers out there? Are consumers wary about, you know, buying apartments off the plan on the basis that they feel as though it's a very risky area nowadays?
It appears the media exposure on those properties that have been impacted have actually painted that whole sector in a negative light. And what we've seen is an increase of buyers looking at an Art Deco apartment or a property that may have been built, you know, 30 years ago.
Yeah.
And they will choose that over a newer property purely for safety. Safety, you know, Peter, safety is a big thing in real estate. People put a premium on safety, particularly when you're outlaying 700-800 grand. So you're seeing classic scenarios where you've got a newly built property, say in Ashfield, Summerhill. You can get a newly built property for 800, yet someone will go pay 900 for the Art Deco, same size unit. One of the reasons is there's always an attraction with, you know, original features, charm, character. But the other reason is these things have tested 40, 50, 100 years of being there. And people say if it's been there 100 years, it'll be there another 100 years, where you can't say that with some of the new projects.
Okay, but you also understand markets. It's a hot issue today. If there are no problems over the next 5 years, effectively, are some of these new apartments great buying opportunity?
They are, particularly if you're an investor, because the tax concessions that you get on new properties is incredible. So I would say it's the classic scenario. It's having the courage to do what everyone else is not doing, right? And benefiting out of that, because at the moment, you're actually going to buy at reasonable prices those new properties. And if you don't get caught up with buying one off a builder who has not done things properly, and I'd say that most builders do things properly, right? So if you end up buying a property from a well-built builder with a good reputation, and you're buying something at a reasonable price, if you're an investor, you're picking up decent rent, you're picking up the tax concessions, depreciation, what have you, and you're also picking up a property that is probably going to be bought at a better value because of the negative media.
Okay, Tom, I've asked all the questions I care about. Is there an important question out there that you get a lot of the times, and therefore you can give us the answer to that question?
I don't know whether I can give you an answer that's going to be 100% correct, but I can give you the question I'm always asked by people is, where's the next hotspot? You know, where can I Peter, you're sitting there. That's where should I buy? What's going to take off? And I would say, and my formula for me dealing with clients, but also my own strategy in my own life has been really simple. What matters to you more? Do you care more about having a property go up by hundreds of thousands of dollars a year, averaging it out over a 10-year period? Or do you care more about getting high rent? Because you would buy a different property for a different strategy.
Yeah.
So I'm 52 now, and I can tell you, my first 20 years of real estate, all I cared is about growth. All I cared was to buy a terrace in Newtown for 500, and in 7 years to say it's worth $1 million. I made that. I'm 52 now, and I'm at the next phase of my life where I'm thinking to myself, hey, what's the point of being like 75, 80, having, you know, millions and millions of dollars of real estate, where really I just want the income so I can go off and holiday and choose to do things that I like. So all of a sudden, yield becomes more important to me. And residential is, you know, in good areas that got capital growth, it's only going to give you about 2%. So I think question number one, getting back to you, answer your question, you've got to find out what matters to you more. If capital growth is the answer, I would say you cannot go wrong buying houses as close as possible to the city centre. You can't afford Newtown, go to Enmore. You can't afford Enmore, go next west, go to Marrickville. You can't afford Marrickville.
The ripple effect.
Your ripple effect.
Yeah,
so what
sure.
you do is you pick the suburb next to the suburb that's taken off if this suburb hasn't taken off yet.
Yeah. When we bought in Paddington in 1979, because no one wanted to live in Paddington in those days, but Bondi Junction, Waverley, Double Bay, those sort of suburbs were where people wanted to live, and we couldn't afford it, so we went to the next suburb.
You've kept Paddington?
Yeah, we have.
You've done well.
Yeah. All right, so one last thing then, for yield, what's the favoured suburb for yield?
Yield, I do like outside of Sydney and Melbourne. I do like Brisbane. You get reasonable yields in Brisbane, and you also get reasonable yields in suburbs that are in Sydney and Melbourne, but I'll give you an example. St Mary's. You go off and here's an example of something. Penrith Way. You buy yourself a property, a duplex site. So it's a house. You rent it out, you buy it for $550. You rent it out, you probably get $500 a week. It's a duplex site, which means at some point down the track, you can knock that house down and build two on there. So what you're doing is you're buying something that's giving you a reasonable yield, like $500 a week for something that you're going to pay $550, and you've also got that option down the track to say, I'm going to knock this down and put another duplex on, and I'm going to have two properties on there. But what a lot of people are doing, Peter, is that they're building granny flats in the back of these houses, and it'll cost you about 110 grand, 120 grand to build a granny flat, and you'll get another set of income coming in. So they're the things that, you know, people with yield, and of course, if you've got a high appetite for risk and you don't mind it, you start looking at commercial property. You start looking. There's been a heap of service stations. 7-Eleven servos that got sold late last year. There was about 30 of them sold. They all sold at yields at around 5% net, right? they're pretty good, and they had long leases. They went to 2030, 2035. So you rent them out.
Better than term deposits.
They are better than term deposits. They are better term deposits, but there's a group of people that Peter have lost a lot of money because they've had money sitting in term deposits for 15 years.
Yeah, exactly right, mate. Good to talk to you.
Thanks a lot.
That's Tom Panos. Tim Slattery, thanks for joining us.
Thanks for having me on, Peter. Great to be here.
All right, now I think a lot of people have heard the name APM Property Group, but people who aren't experts in that part of the property market would be keen for you to explain, what does the company actually do?
So, Peter, we're a specialist real estate investment manager. That means that all we look after is commercial property investments across Australia. We invest principally to give investors in our products access to the commercial property rental income streams that you can generate from those investments. So we've been in business for about 20 years. That's all we've done since we started out, and that's all we do today.
Okay, so tell us about the products that people can access. I'm going to get you to give us your view on commercial property going forward, but I think I want people to understand precisely what your business does. So if someone wanted to say, after they read all the disclosure documents and whatever, they want to play ball with you guys, what are the kinds of products they can play ball with you with?
Yeah, absolutely. Well, the short answer is there's really two. To use your analogy, there's really two games. So the first opportunity is that we have 12 different commercial property funds that are available for investment. They've got a range of minimum investments from sort of $1,000 right up to multi-million-dollar investments from some of Australia's largest institutional investors, and there are listed property funds as well as direct property funds. There's a range of asset classes, so we have funds that invest in convenience retail, so service station portfolios with long leases to the likes of Woolworths, 7-Eleven, those sorts of businesses. We have an industrial property fund that will own a portfolio of warehouses, leased to the sorts of businesses that are active with online retailers and the distribution of goods between the various retailers and consumers. And then we also have funds that will take a more active management approach in, say, the office space, where we'll have a building benefit from some capital expenditure to upgrade the facilities to improve its occupancy levels and those sorts of things. So all of those funds will offer people distribution yields, so cash distribution yields of between sort of 4.8% up to sort of 7%. And there's a range of different strategies there. So that's one way to participate. The other way investors can participate is that our management company is also available for investment. So we're listed on the ASX. The code for the company is APD, and we basically do two things. The first thing we do is provide management services for which we receive fees for managing those funds. And the second thing is we also invest our own money in those funds. So there's really two different ways that investors can participate with us.
Yeah, so if you wanted to bet that all of your funds and other investable products would do well, you could tap into the listed vehicle,
correct,
which should be APD.
Yep.
APD. Or if you wanted to drill down into specific kinds of investments, like if you believe that the online world is going to be great for warehouses, they could go into a fund that specialises in providing money to the warehousing sector in the industrial space.
That's absolutely right. That's a very good, simple summary of the two ways to play it.
Okay, well, I'll charge you for that little explanation because it was very good, I got to say. All right, just joking, Tim, of course. All right, so where does APM Property Group come from? What's the history of it?
So APM started out in 1996, and it really had its roots as a builder and a property developer. So we've got a long-standing view that property is one of those asset classes that you need to get very, very much down and dirty with the assets and close to the investments that you're looking after. So, understanding construction costs, land values, the ins and outs of leasing is very much where APM comes from. And I guess that real estate DNA is still something that we value very highly today. So the business basically had its background as a developer and a builder. But now really all that we do is invest on behalf of our investors into commercial real estate.
Yeah, now in the age of very low term deposits, lots of investors are looking for income in alternative spaces. And I think I saw you provide a chart at one of your conferences that basically showed that, income-wise it's fairly stable, but, for example, with the listed product, I guess, that one can be affected by the market. Is there an emphasis in your group to try and be a deliverer of income?
Yeah, look, definitely. That's a central way that we invest. So we very much focus on the sustainable cash flows that are available from any particular investment. And that's true whether an investor is investing with us in a single property for, say, a 5-year fixed term sort of strategy, or whether one of the listed funds that is available for application and redemption, or you're trading on the ASX on any given day of the week. So the central idea is investing for long-term sustainable cash flows, which we're obviously trying to grow over time. And then within that, there's really a range of options for people. As you say, some investors would like the idea of being able to access their capital as and when they see fit through the listed market or our funds that have daily liquidity, and then others, I think, are preferring to sort of make an investment for 5 plus years to see an investment through a particular strategy.
Do you have an opportunity for investors to invest in a specific product, a specific building, where you actually nominate the building? Investors pool their money and they become effectively part owners of a building?
Yeah, absolutely. We have 3 or 4 funds that do exactly that, that are in existence today. So as an example, we have a fund which is called the APM Regional Property Fund. It owns 2 office buildings based in Newcastle, so 2 hours drive north of Sydney. We have Government Property New South Wales, so the New South Wales government as a major tenant. They offer a distribution yield of about 7.1% per annum, with gearing of around 40%. So that's debt to the value of the assets. But that fund just owns those 2 office buildings, and will own them till the fund is due to expire, and we'll liquidate the fund in 2024. So that is a fixed term, single property fund that's designed to do exactly that.
And so in that case, do people get distributions along the way, like the receipt from the rents effectively, and then eventually do you sell the building as a capital gain, you divvy that up amongst the owners?
Yeah, that's exactly right. So it's really what we're doing is providing investors with an opportunity that they wouldn't be able to access by themselves. Buying a $55 million office building for a lot of investors is just out of reach. But small slice of it, buying a unit in the trust that owns it, and we'll look after finding the property, looking after it, hopefully growing the rents and hopefully selling at a profit on behalf of those investors is really what our products are designed to do. So you're exactly right. Investors get the income along the way, and they'll get whatever upside capital growth, or if something's happened over the journey, if things go down as well as up, that will be their results as well. But it's really you own a small part of that office building in that fund.
And are there opportunities in case you needed to get out for personal reason that you can get out of these sort of funds?
It just depends really on exactly which fund. So a lot of the funds have liquidity measures in them. Some of them have daily liquidity. Some of them are traded on the ASX. Others have liquidity windows, but some are fixed term funds. So you really need to sort of make sure that you're clear about what you want to do. Some funds do really have limited liquidity, other than the ability to sell it to someone else. But obviously that's a less commonly used approach.
Yeah, okay, fine. So basically people should read the disclosure documents to make sure it suits their investment goals. 2020, what's it looking like for commercial property?
Yeah, look, I mean, we think, I mean, it's been a great few years already. So I think people are right to sort of ask that question. How much more growth could we expect to see? Are there risks on the horizon? Our view is still that we expect low interest rates across the board to continue throughout 2020, and we think that provides an excellent, sort of foundation for good returns in commercial real estate throughout next year. We think if you can buy a commercial property investment that's sort of yielding 5, 6, 7%, you're buying real assets. So you have a physical asset that's supporting your investment. We think that compares pretty well compared to the other options available in the market. So I think with anything, you also, as a property investor, you've got to look at exactly what you're buying. There are differences in different markets. Clearly, some markets are more affected by, the exposure to the resources sector, or in Melbourne, Sydney, the financial sector, different areas of population growth depending on what it is. Retail, so you need to look at exactly which sort of assets you're buying, but we still think that online retail and the growth in demand for logistics and warehousing properties will stay strong through 2020. We also think there's value emerging in some of the shopping centres that have obviously been affected by the growth in online sales, but they're reinventing themselves, and like everything, it really depends on buying well, and we think there's value emerging in some of those parts of the market too. But we think overall, the sector's still well positioned.
And I would figure that if the Aussie economy over 2020 starts growing more strongly, that will also give a bit of a foundation to many of those commercial building investments you're in. And if that's right, and I presume you guys then will be looking around for your most reliable forecasters on what's going to happen in the Aussie economy. What are you guys being told by the people who you rely on for the outlook for the economy and therefore your investments?
Yeah. Look, I think, very in a big picture view, we see a fair bit of strength emerging offshore in the US, but it's a bit of a different story in Australia. So, fantastic country to live in and all those things. But from an economic perspective, we still see, while we're at relatively high levels of employment, there's still not a lot of wage growth, not a lot of productivity growth. You've seen the sort of federal budget update. So clearly some pressure points there. We still think that means that we will see low interest rates. Yeah, you're right. If we do see growth, one of the great things about property is that we should see rental growth coming through if we do see a pickup in inflation and growth. But I think for 2020, our view would be rates stay relatively low, and we don't see a huge amount of growth. But also, we still think there's probably pretty good demand for commercial real estate assets that are offering a decent investment yield.
Okay, one last question. Is there any question you think I should have asked you that would actually explain to my viewers, anything they need to know about APN?
Oh, look, I think really just what our track record has been. We spend a huge amount of time on our governance and making sure that we're a great company to invest in. We actually have a long-term view. I think a lot of companies say that they have a long-term view, but we absolutely mean it. We've got a lot of our own capital invested, skin in the game with our investors in the funds and with the investors in the company. So we think that stands us in good stead, and we're all aligned. So we think that the future's bright, but I think that's a key point of difference for our business when people are thinking about where to put their money.
Tim Slattery, thanks for joining us.
Thanks very much, Peter.